Right now, Wall Street is pouring hundreds of billions into AI. Data centers are expanding at record speed. Enterprise AI systems are scaling globally. Governments and corporations are racing to secure AI infrastructure before the next wave hits. But almost nobody is paying attention to the smaller companies operating underneath this expansion. And that's where things start getting dangerous for the market. Because while retail investors keep chasing the same trillion-dollar AI names, some micro-cap AI infrastructure companies are still trading at levels that look completely disconnected from the broader AI boom. One is sitting at just 0.14, another trades around 360. Now this is where things get interesting. How do companies connected to enterprise AI systems, high-performance infrastructure, and next-generation computing trends end up priced lower than some random meme stocks? But here's the catch. The market usually notices infrastructure layers late, not early. And historically, when money finally rotates into overlooked AI infrastructure plays, that's when pricing inefficiencies can close very aggressively. Because while most investors focus on visible AI hype, institutions often watch the systems operating underneath it. AI is no longer just software, it's becoming an infrastructure race. Data centers are expanding, automation systems are scaling, enterprise AI deployment is accelerating, high-performance computing demand continues rising. And this is where pricing inefficiencies usually exist, because most investors focus on consumer-facing AI companies, while institutions quietly monitor the back-end systems supporting long-term AI expansion. This is the type of layer institutions quietly watch. Now, this doesn't guarantee anything. These are still smaller cap companies. Volatility remains high, execution matters, timing matters, but it explains why this area matters. Because if AI adoption keeps moving deeper into enterprise infrastructure and high-performance systems, this is exactly where smaller cap opportunities tend to form. Most investors think AI infrastructure only means semiconductors and cloud computing. But another layer is quietly becoming more important. AI-powered workplace systems and enterprise environments, as companies increasingly integrate AI into daily workflows, office systems, analytics platforms, and digital operations. The need for intelligent workplace infrastructure naturally grows. But here's the catch. Most investors completely ignore this category because it doesn't generate the same excitement as mainstream AI names. And this is the part most people miss. The companies operating underneath enterprise transformation trends often stay overlooked during the early stages of adoption. Interestingly, the second company we'll discuss later approaches AI infrastructure from a completely different angle, focusing more on thermal management and performance systems behind advanced computing. This company operates in the enterprise AI workplace infrastructure layer. That includes AI-powered workplace analytics, smart office environments, enterprise automation systems, digital experience infrastructure. As businesses become increasingly data-driven and AI-integrated, demand for intelligent operational systems naturally expands. And if this layer grows, companies like this become critical. Because eventually, AI adoption moves beyond software into the environments where businesses actually operate. This stock has already experienced extreme volatility. Shares previously traded above $10 during earlier AI enthusiasm cycles, then collapsed sharply as speculative tech sentiment weakened. And now the stock trades around $0.14. Now the question becomes, is this simply another forgotten micro-cap stock? Or a neglected AI infrastructure play sitting inside a market inefficiency? The company focuses on enterprise AI workplace solutions used for digital workplace management, AI-driven office experiences, smart enterprise environments, workplace analytics systems. Its entire model revolves around integrating AI into real operational infrastructure. And when you actually look at the company behind this, This is where things shift. The stock is CXApp, ticker CXAI, currently trading around $0.14. So why hasn't the market fully priced this in? Because smaller cap enterprise infrastructure companies often struggle with visibility and investor confidence. This doesn't mean it moves tomorrow. There are real risks here. Execution, adoption speed, and funding stability all matter. Timing is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding globally, many infrastructure-focused AI companies still experience delayed price reactions because markets usually reward visible AI software first and infrastructure layers later. And historically, that's exactly where pricing gaps tend to form. But unlike the first company, this one operates much closer to the physical infrastructure supporting advanced computing systems, where the first company focuses on workplace AI environments. This company focuses on thermal management, battery systems, and high-performance infrastructure technology, and that creates a very different type of AI exposure. In simple terms, its technology helps powerful systems operate more efficiently and safely. And as AI computing demand expands, infrastructure support systems like this become increasingly important. If AI adoption continues scaling aggressively, then the demand for high-performance infrastructure support naturally increases alongside it, because eventually, advanced computing systems require efficient cooling, thermal regulation, and power management to operate at scale. And this is where infrastructure layers become critical. This stock has also experienced major volatility. Shares previously traded below $1 before gaining momentum during infrastructure and AI-related speculation, then stabilized after significant upward movement, and now the stock trades around $3.60. Now the question becomes, is the market already pricing future infrastructure demand, or could AI expansion continue increasing relevance for this category? And this is where it gets interesting. The company is KULR Technology Group, ticker KULR, currently trading around $360. But here's the reality. Infrastructure technology companies still face uncertainty around scaling, execution, and future adoption demand. This doesn't guarantee anything, and there are real risks here, but market inefficiencies often appear where investor attention remains limited. Now compare both companies carefully. One focuses on enterprise AI workplace infrastructure. The other operates closer to physical infrastructure systems supporting advanced computing performance. One trades at just $0.14 in deep micro-cap territory. The other already sits near $4 with stronger infrastructure visibility. So which one benefits faster if AI infrastructure spending accelerates, if enterprise AI environments scale aggressively? The first company could benefit from digital workplace expansion, but if high-performance computing demand continues rising faster, the second company may gain institutional attention more quickly. And this is the part most investors miss. Infrastructure layers often move later than hype cycles, but sometimes much more aggressively once adoption becomes visible. At the end of the day, both of these companies sit inside the same broader trend: AI infrastructure, not consumer AI hype, but the systems operating underneath long-term AI expansion. And historically, this is the layer that tends to move later, but often more aggressively once institutions begin pricing future adoption more seriously. If you want more breakdowns on overlooked AI infrastructure stocks trading under the radar, subscribe, because the next phase of the AI market may look very different from the first.